Right, welcome back, guys. This is a continuation of our Forex analysis. We started looking at fundamental analysis, and we followed that up with how to read the Forex calendar. So now in this continuation, we're going to be looking at technical analysis. Basically, in this section, it's more of like an introduction to Forex technical analysis. Reason being that technical analysis is quite a broad subject in Forex, meaning there's quite a lot that has to be covered, and most of it I'll cover it in my advanced course. So in this section, it's more of like a basic introduction to technical analysis. So what are we going to be looking at in this section? We're going to be looking at the origins of technical analysis. How did it come to be? Then we're going to look at the general elements of technical analysis. And then we're also going to look at how does it help? Does technical analysis really help you as a trader? Does it help you in making a decision to go long or to short? And then we're gonna look at some technical indicators. And then we'll talk about basic principles of technical analysis. And then we're going to cover up what I would say the three most important criteria in technical analysis. These being trend lines, support and resistance, and then channels. There's quite a lot of tools that one can use in technical analysis, but in this introductory part, we're going to be covering those three only. And then finally, we'll conclude the section for Forex analysis. So technical analysis is statistical in nature because the data it analyzes can be easily quantified and further visually demonstrated through charts and chart overlays. In this article, or in this section of the course, we are going to explain how to learn Forex technical analysis and where to start with it in regards to technical trading. In Forex, as well as in many other financial markets, be it stocks, commodities, or indices, technical analysis is a method of price forecasting for financial assets. In Forex, we look at currency pairs using 5 basic units of historical data, which is the opening price, the highest price, the lowest price, and the closing price. The fifth dimension is represented by the volume, but this can be problematic in the Forex spot market since it can't quite be measured in the same way as it is with stocks, commodities, and even Forex futures. So why then use technical analysis? That's one question which I've been asked quite a lot. Technical analysis is a tool that has proven to be useful in a variety of financial assets to predict future price movement. There are traders in stocks, futures, options, cryptocurrencies, and Forex who use technical analysis to base their investment decisions. Successful trading requires one to be able to time markets to catch a strong trend. Technical analysis is an important tool for active traders. Many traders use technical analysis as a way to catalog market data and establish a system to pick entries, exits, and manage their risk. Technical analysis shows you high probability areas where a stock's trend will begin and end. It is very useful for predicting short-term trends in the market. So when we're talking of technical analysis, it involves the previously mentioned criteria, and also it includes chart types, price patterns, indicators, support and resistance. The Elliott wave theory is a form of technical analysis. So now let's look at the origins of technical analysis. This form of market analysis has existed for as long as there have been markets driven by supply and demand. The first known historical records are dated around the 17th century for Dutch merchants and the 18th century for Japanese rice traders. At the end of the 19th century, technical analysis began to take off as it was propelled into the trading masses by the founder and editor of the Wall Street Journal, Charles Dow. Among his contemporary compatriots were other technical pioneers, Ralph Nelson Elliott, who's the famous founder of the Elliott wave theory, William Delbert Gann, the founder of the Gann-Engels theory, and Richard DeMille Wyckoff. Wyckoff was possibly the first market psychologist who theorized that the market, with all the historical data recorded, is the best considered as a single mind. His teachings are still taught at some of the top universities in the United States. For most of the 20th century and throughout history, technical analysis was limited to charting, as statistical computation of vast amounts of data was unavailable. That means no indicators. It also means that now the digital era can probably be considered as the golden age of technical analysis. So here are the general elements of technical analysis. Although Forex technical analysis typically employs numerous tools, techniques, and methods, it is generally chart-bound, meaning most of your analysis is done on the chart. Traders use charts, which are nothing more than price history depicted graphically, which is the search for price patterns. Price patterns, whether they are trend patterns, reversal patterns, or ranging patterns, are market formation, commonly referred to as market moves, that increases the probability of winning trades. For many technical traders, the trick is in figuring out what the current mood of the market is and how long is it going to last, in order to figure out how to plan their technical trades. To identify these major patterns, traders have developed and perfected a series of charting tools. They start with support and resistance lines, price channels, and then end with a multitude of technical indicators which are applied directly to their charts in real time. So, does technical analysis help? Some people believe that looking at historical price data will not provide any value for current decisions. They may believe that the random walk theory or efficient market hypothesis is true, which states that financial market prices move and behave to a random walk, whereby price changes are random and thus cannot be predicted. Many investors, however, heavily dispute this theory, including famous investor Warren Buffett, who commented that he is convinced that there is much inefficiency in the market. Inefficiencies, in turn, create potential opportunities for traders to capitalize on price movements. They believe that analyzing price action, in fact, enables traders to make better, more informed trade decisions. So yes, technical analysis does help. How and why does technical analysis help you as a trader? The financial markets are not simple to analyze. They are impacted and influenced by a wide range of factors, including, for instance, monetary policies, administered by central banks, fiscal policies delivered by governments, and many internal economic factors that are determined by companies and consumers alike. Studying all those factors, realizing how they impact all of the assets and markets, and knowing which factors have the most impact is an incredibly difficult task. Equally important is that when analyzing these factors, it is easy to see that traders can make errors in cause and effect. This is particularly true for individual traders who have limited time and focus. However, the good news is that there is a reliable shortcut whereby analysts can focus a lot of their attention on just one piece of data: price movement. Technical analysis is also known as chart analysis. Technical analysis allows traders to analyze historical price movement. This analysis can then offer traders, number one, a way to judge whether the chart is interesting to trade or not. It can also offer traders how traders can look for potential trade setups, where traders can find potential trade setups, and how to manage those potential trade setups. So now let's talk a bit about technical indicators. There's quite a large array of indicators out there which technical analysts can use in their day-to-day trade. So technical indicators are statistically programmed add-ons for the body of trading platforms that mathematically analyze relations between various elements in an attempt to assist with price prediction. Broadly speaking, there are four groups of technical indicators. The most popular ones are trend indicators, momentum indicators, volatility indicators, and volume indicators. As you can see, when it comes to trend indicators, we're looking at mainly the most commonly used moving averages, the ADX, average directional index, the Ichimoku cloud, the moving average convergence or divergence, popularly known as the MACD, and then we've got the parabolic SAR indicator. Under momentum indicators, we've got RSI, which is the relative strength index, which is also commonly used. Then we've got the stochastic oscillator, we've got the Williams percentage range, and then under volatility, we've got the average true range, ATR, we've got the Bollinger Bands, we've got the standard deviations, and then under volume, we've got money flow index, we've got accumulation and distribution lines, we've got on balance volumes. So these are some of the technical indicators which traders use. These traders, you can apply them on the platform that you trade on, whether it's MT4, MT5, C-Trader, or any personalized platform that you use. Mostly they all have these indicators. So what are the basic principles of technical analysis? Right, the basic principles of technical analysis. Number one, price action discounts everything. The logical framework and justification of technical analysis derives from one of the Dow theory postulates, which claims that the price accurately reflects all relevant information. Thus, whatever factor has an impact on supply and demand, which is the primary price moving forces, will inevitably end up on the chart. As for researching or even being aware of the events outside price action, they are mostly rendered useless as they are unquantifiable and may provide unreliable data. Number two, price moves in trends. Technical analysts tend to favor the trend-like nature of the market. Another echo of the Dow theory, markets can move in uptrends, which we normally refer to a bullish market. A bullish market that continuously creates higher highs and higher lows, while in the bigger picture the price seems to be jumping up and down within an upward corridor or channel. A similar market behavior, only characterized by lower lows and lower highs, constitutes a downtrend, which we normally refer to a bearish market. A horizontal trend is called a ranging market and is not a particularly desirable place for a trader to be. This is because during the ranging periods, there is hardly any way to be certain about what will happen next. A ranging market means that the bulls and the bears are more or less equal in power. No one really is in control of the market, and neither side is strong enough to dominate another long enough to form a trend. Markets range on average about 60% of the time, which makes identifying trends extremely important. It's worth remembering that Forex statistical analysis doesn't concern itself much with the whys of why things happen. For example, why do trends occur? Would be a reasonable question, but to a technical trader it's completely irrelevant. They just wouldn't know how to quantify the answer. To them, the existence of trends is simply an empirical proven fact. Number 3, on the basic principle of technical analysis, history repeats itself. Technical analysts agree that investors as a whole operate in patterns because of this behavior. Technical analysts believe that they are able to accurately identify patterns and make trades with a higher probability. All they need is a small statistical advantage multiplied by repetitions and leverage. Pure technical Forex analysis isn't the best idea. It is often used in some sort of combination, along with a fundamental analysis or a sentiment analysis. Truly, while technical analysts may excel at identifying and confirming trends, it is the fundamental shifts that organize conditions for those trends to develop. One last thing to consider is the method of Forex backtesting, also known as historical backtesting. This is a method employed by traders that use historical data to test a trading strategy. It can only work with technical Forex analysis. As with all statistical findings in any area of human activity, past data does not guarantee that the pattern or the probability will last. It is only a tool. Additionally, backtesting requires traders to know the exact market conditions for entry and exit. So now let's look at some technical tools. And firstly, we're going to talk about trend lines. Right. Trend lines are a form of support and resistance. Support and resistance is also a technical analysis tool. They are more or less the same. Only difference is that trend lines are plotted diagonally on the chart. Here's examples of bearish and bullish trend lines. Number 1, you can see the illustration of what a bearish trend line looks like. Right. The red line represents price movement on a chart. Right? We all agree with that. But during that price movement, price is in a downtrend as described on the previous section. Price is forming lower highs, 1, 2, and 3. Those are lower highs, and when you connect those highs together, then you've got yourself a trend line support, right? And then eventually price will break out of that line and then retest. So this will be your entry to the upside. So this is a bearish down trend. So now let's look at a bullish trend line. Bullish trend line is the opposite. Price will be moving in a uptrend, forming higher highs, higher low, higher high, higher low. 1, 2, and 3. Those are higher lows. When you connect those three numbers together and extend the line, that's your trend line support. So this is a bullish trend line. So here we've got an illustration of a bearish trend line. Then here we've got an illustration of a bullish trend line. Now let's look at support and resistance. Right, support and resistance is one of the main technical analysis tool that almost most traders they use, even beginning traders, people who are starting in this industry. You have to learn support and resistance. Right, so what is support and resistance, and what is it when we are talking about support and resistance in trading? Right, principles of support and resistance. Before we go to the illustrations of what is support and resistance, principle A states that support and resistance levels flip when broken by price. A support level that is broken or violated tends to resistance. A resistance level that is broken or violated tends to support. Broken or violated means a clean candle close through the level. This basic principle is the backbone of most price action trading concept. Principle B, recurring test of a level. That is a level that keeps on being tested. The more a level is tested by price from the same direction, the weaker it becomes. A support level that is tested repeatedly as support becomes weaker with each test as buyers are absorbed each time. A resistance level that is tested repeatedly as resistance becomes weaker with each test as sellers are absorbed each time. While a level that is tested by price many times from the same direction is weaker with each test, it becomes strong if and when it flips. Basic principle number 3. First test, best test. This is a logical result of principle B. The highest probability level trade is the first test of a broken level from the other side, meaning a first test of a broken or violated resistance level. You have to expect support when price comes back to that level. A first test of a broken support level, expect resistance when price comes back to the level. Given that the probability of a level holding decreases with each test, one's odds are enhanced when price tests a support or a resistance flip for the first time, before any buyers or sellers have been absorbed. Any subsequent tests are lower probability, but can still be taken if your trading rules permit, e.g., for example, if there is confluence of some sort. Now let's take a closer look at support and resistance level representation. Right. Firstly, we've got a representation of resistance. So the arrows are depicting price movement. The arrows, they are predicting price movement. As you can see, price moves high, it reaches a point, and then it recorrects to the downside. It moves high again, reaches the same point, bounces to the downside, reaches the same level, and bounces to the downside. The point at which price is turning, these points here, from the upside point of view, that's what we call a resistance level. See, that's what we call a resistance level. Now below, we've got an illustration of support. So price is moving to the downside, finds a price level that it bounces, go back, comes back again, it bounces on the same price area, it goes back, bounces on the same level, and it bounces back. So this is what we refer to as a support level. Now we've got a resistance level turning to support after being violated or broken. As you can see now on illustration number 3, price is testing a resistance level. On the third time, it breaks and closes above. When it comes back again to the same level, now the level is a support level, meaning you're looking to trade long. This test here, the first test of a broken resistance, offers a much better opportunity to go long. Now on the fourth illustration, you can see a support level being tested. Price rallies, comes back and retest, price rallies, test and break below, right? When price comes back to the level that has been broken here, this level becomes resistance. So there's better chances of taking a short trade on a support that has been broken. I hope you get me clearly in regards to the illustration. So this is the basics of it, of resistance level, support level. A resistance level tend to support after being broken or violated. A support level tend to resistance after being broken or violated. Support and resistance time frame. So here we're going to talk about on which time frames do you look to draw your support and resistance levels. Usually higher time frame levels are more consistent than lower time frame levels. Nevertheless, the occurrence of setups will be substantially reduced if you only trade clean daily time frames and above levels. Meaning, if you trade daily support and resistance level, weekly support and resistance level, or monthly support and resistance level, you see that the occurrence of setups of trades is going to be limited or reduced, because support and resistance level, they don't form as often on higher time frames, but if they do, they are quite to the point, as in they offer better chances. Personally, most of my level trades are on the 4-hour time frame and the daily time frame. Finding a time frame that works for you find a time frame that works for you and gives you a good balance between setup frequency and setup quality. Yes, there are people who use support and resistance on 1 minute, 5 minute, and 15-minute time frames, but those are only gonna offer you scalping opportunities, and in most cases, some of those levels, they are not like a true depiction of the market structure. So the levels, they tend not to offer good or clean trade setups. So you find out that on a 5-minute or 15-minute chart, a resistance or a support level can be broken with ease, and then you'll be like, but why did it break that level? But that has got nothing to do with the why. It's got to do with your time frame. So always consider working with time frames at a higher time frame level. Understanding support and resistance flips will make most concepts much easier to learn and understand. Don't forget that testing a price structure from the same direction repeatedly makes it weaker. It only becomes strong when and if it is broken. It is easy to add other trading principles to confluence with support and resistance, e.g. Fibonacci levels, other indicators, other price action structures. Meaning, once you have your support and resistance, it's easy to add other elements of technical analysis, which is like this Fibonacci levels, for you to make a decision on what you are going to be trading. So here's an example of support and resistance levels. This is a Euro USD monthly chart. As you can see, we've got the 109 level here. This is a strong level of support, right? You can clearly see that is a strong level of support. But if you look from where the chart starts, the level was broken here, right? And then price rallied. When it rallied, it came back to the same level. That's a support level, which is what? Flipped. No, a resistance level, which is flipped. So now this level becomes support. You see? So price rallies away. When it comes back, it offers support, right? Same applies from the upside. If you look at the 16-year resistance, price always finds resistance in this level, right? So this is a monthly chart of Euro USD. So you can do this in hindsight, you see? And then you study the charts and you see, okay, this level here, it offers resistance, and you can see on the chart that there is support there, right? Not the resistance, there's support. Same applies if you look at this area, the 104, there is resistance here. There's support, sorry. There's support at that level, meaning price always look to trade to that area and bounces to where? To this area. You see? Now that's your resistance. You see? You can clearly see here we've got resistance. We've got resistance. And it was broken here. Now that's a flip. You see? That level was broken. And then market trade higher. And then it came back. See the first test here. It offered this chance to go to the upside. Right? And then it came back. It broken here. Support level that is broken becomes resistance. Market trade to the downside. When it retested here, you see it offered a chance to go to the downside. So in hindsight, you should be in a position to identify your support and resistance so that you learn from it. You see, it's much better to understand market when you do hindsight analysis. Now, let's look at the third technical analysis tool, which is most commonly used. Now, these are the channels. A channel is only of any use to use if it terminates at an important area to trade, such as a supply and demand zone or a support and resistance zone. In this beginner's guide, we are not going to focus on supply and demand. Supply and demand concept are now for the advanced class course, which I'm going to be uploading very soon. It's still in production. So channels, we've got bull channels. These form after a price spike that peaks out and slowly forms a short-term reversal downtrend. The starting point for the trend line should connect the highest high, which is the upper trend line, and the highest low, which forms the lower trend line, to represent the channel portion, or commonly known as the flag portion. While the lines are sloping down, they should remain relatively parallel to each other. Eventually, the price should spike up through the upper trend line, triggering shorts. When the price exceeds the highest high, the bull flag is formed, or the channel is formed, as buyers rush in, making new highs, and the next leg of the uptrend resumes. Don't worry, I'm going to illustrate this in the next slide. A bear channel forms after a large price collapse that attempts a short-term uptrend reversal. These are the opposite of the bull flags. The trend line connects the two lows and highs starting from the bottom. The trend lines should maintain a parallel distance between each other until price collapsed back under the lower trend line. This triggers longs to unload their position as panic sets in when the price falls through the lowest low. This triggers the bear flag or the bear channel breakdown and subsequent resumption of the next leg of the prior downtrend as prices makes new lows. Let's take a look at illustration of bull and bear channels. Right. Firstly, let's look at bear channel. During a downtrend, normally after a big impulsive move, the bear channel represents a chance for the market to regroup before continuing with the down momentum. Normally, volume diminishes during the market pause and then rapidly expands prior to the continuation. The bear channel is an upside version of the bull channel or a bull flag. It is the same structure as the bull flag bit, only that now it's inverted. They are mainly made up of higher highs and higher lows. They normally form after a large price drop and attempt a short-term uptrend move. As you can see on the illustration, we've got this impulsive move to the downside, right? And then market attempts to correct to the upside before another strong impulsive move to the downside. Now here is the illustration of a bear channel on a chart. This is Euro USD. You can see price reached a strong level of resistance, right? Then to massively or impulsively move to the downside, and it attempted to move to the upside before market breaks to the low and then continued with a downward movement. So now let's look at a bull channel. During an uptrend, normally after a big rally, the bull channel represents a chance for the market to regroup before continuing with the up momentum. Normally volume diminishes during the market pause and then rapidly expands prior to the continuation. It slowly forms a short-term reversal downtrend. Bull channels are characterized by lower highs and lower lows. You can see here we had a strong impulsive move to the upside, meaning market is in an uptrend. Then there was this attempt here to go to the downside, you see, but eventually this uptrend here resumed here and then broke above the channel so that market can continue going to the upside. Now here's a bull channel representation on a MT4 chart. We've got price moving to the upside. Price is in an uptrend or a bullish momentum. Then we had a small correction to the downside. Market tries to go to the lower side, but you can see in that time it traded to a strong area of support. See, this was resistance. Price broke here, traded above. When it first retest, you see there's a strong chance of going to the upside, but eventually this channel here, this correction to the downside does not hold and market break above and then continued with its uptrend. So that's a representation of a bull channel on a MT4 chart. So the three that I have mentioned, the channel, support and resistance, and the trend lines, those are the three main technical tools that most people tend to use in their technical analysis. So to conclude this section, Forex market technical analysis is a method of evaluating trading instruments by analyzing the statistical record of their price history. Technical analysis is not concerned with the factors that influence bulls and bears, supply and demand, or any other factors that may affect price. By analyzing only what has already happened, can technical traders gain their competitive edge? Most often, the price history is committed to charts by the means of various charting methods, with Japanese candlesticks being one such method, which we are going to be using more often as we move forward. Various tools such as support and resistance lines, trend lines, and technical indicators are used to analyze charts in an attempt to identify patterns to trade from. Patterns are the key concept in technical forex analysis that everything revolves around. The existence of market trends is a proven fact and is of utmost importance to every technical trader. Despite daily forex technical analysis being criticized in some academic circles for its insolvency, most practical traders from various institutions, they apply at least some form of it, usually in combination with other methods. So this concludes our section on forex market analysis. We talked about fundamental analysis and we talked about technical analysis. And under fundamental analysis, we also talked about the forex calendar, how to read the calendar and how to apply the calendar. So as we go, you're gonna see that all these concepts, once you come up with your trading strategy, eventually they have to align, meaning you need to consider each and every concept before you make a decision to open your trades. So this concludes the forex market analysis section. In the coming next section, we are going to be looking at the MT4 platform before we go on further to look at candlesticks and the rest of the course. Thank you for joining me, and I hope to see you in the next section. Thank you.